The average 30-year mortgage in the United States now carries a monthly payment of $2,200. 3 years earlier, the exact same property with the same loan structure cost $1,100 less each month. That means another $1,100 disappearing from household budgets every single month. The authority now placed in charge of addressing that crisis has officially assumed leadership of the Federal Reserve. His name is Kevin Warsh. He became the 17th chair of the Federal Reserve on May 15, 2026. President Donald Trump selected him for the position. The Senate approved the nomination with a vote of 54 to 45. It was the narrowest confirmation margin for a Federal Reserve chair in modern American history. Every Democrat voted against the nomination. This was not viewed as a routine appointment. It arrived during one of the most unstable economic periods in recent years. At the moment Warsh entered office, the institution itself was already facing major pressure. Inflation had just climbed to 3.8%. That marked the highest level since early 2023. Only 2 months earlier, the reading stood at 2.4%. A rise of 1.4 percentage points in just 8 weeks was not considered a slow movement. It was a sharp acceleration. Mortgage rates remain directly connected to inflation. For homeowners, that affects refinancing decisions. For first-time buyers, it changes whether entering the housing market is financially possible. Kevin Warsh is 56 years old. He graduated from Stanford before earning a law degree from Harvard Law School. After finishing his education, he joined Morgan Stanley as a financial advisor. In 2002, he departed Wall Street to work inside the administration of George W. Bush. His role included serving as special assistant to the president and executive secretary of the National Economic Council. 4 years later, in 2006, he reached the Federal Reserve Board of Governors at only 35 years old. That made him the youngest individual ever appointed to the board. Warsh remained inside the Federal Reserve during the financial collapse of 2008 alongside Ben Bernanke while major American banks were failing in real time. He was directly involved in those discussions during the crisis. He stepped down from the Federal Reserve in 2011. Over the following decade, he repeatedly criticized Federal Reserve policy from outside the institution. He described the monetary expansion that followed the pandemic as reckless policy. Last year, he publicly demanded what he called regime change at the central bank. Because of that history, his nomination by Trump was viewed as more than a political decision. It was seen as the selection of someone who had spent 15 years preparing to transform American monetary policy. Still, Warsh does not control interest rates by himself. Those decisions belong to the Federal Open Market Committee, known as the FOMC. The committee contains 12 voting members. The chair possesses only 1 vote out of those 12. At the final meeting led by Jerome Powell on April 29th, 4 members dissented. That level of disagreement inside the Federal Reserve had not appeared since October 1992. More than 3 decades of internal alignment suddenly fractured. The dissenting members were not demanding cuts. Several were openly signaling support for raising rates further. That position emerged while millions of Americans were already struggling with mortgage payments, averaging $2,200 each month. Another unusual development complicated the situation further. Before Warsh became chair, he had one consistent ally on the committee. Stephen Myron, another Trump appointee, had repeatedly argued for rate reductions. He supported cuts during 6 consecutive meetings while the rest of the committee refused to move. But when Warsh assumed the chairmanship, Myron's seat became vacant. Warsh effectively entered office after replacing the only dependable supporter he had inside the room. His first major meeting as chair is scheduled for June 16th and June 17th. He will face 11 members who previously voted to keep rates unchanged. CME FedWatch, considered one of Wall Street's most closely followed prediction tools for Federal Reserve policy, currently places a 97% probability on rates remaining unchanged during the June meeting. Markets have already priced in no cuts for the remainder of 2026. Some Wall Street analysts are now projecting a possible rate increase by September. That outcome runs directly against what Trump promised when Warsh was selected. It also conflicts with what millions of American mortgage holders have been hoping for. Now, attention is turning toward the reason the committee remains so resistant to lowering rates. This is the section that explains the entire crisis. Consumer prices climbed by 0.9% during March alone. Then another 0.6% increase arrived in April. On a monthly basis, those numbers project to an annual pace well above 7%. The main force behind the surge was the sharp rise in oil prices following the conflict between the United States and Iran. Energy expenses move through every layer of the economy. Transportation costs increase, food distribution becomes more expensive. Manufacturing costs rise as well. Once oil prices spike, inflation does not remain isolated. It spreads across nearly every sector. The Federal Reserve has one primary weapon against inflation: maintain elevated interest rates. Higher rates reduce borrowing. Reduced borrowing weakens spending. Less spending helps cool prices. But the same high rates also keep mortgage costs elevated. That is the position Kevin Warsh now faces. He wants rate reductions, yet the inflation numbers are moving directly against him. Another major detail has received very little attention from financial media. Jerome Powell still remains inside the Federal Reserve Building. Powell's role as chair ended on May 15, 2026. However, his position as a Federal Reserve governor continues until 2028. He is staying on the board. For the first time in more than 75 years, a former Federal Reserve chair will sit beside his successor while voting on the same interest rate decisions. That situation changes the internal balance of the committee. Warsh cannot avoid comparison with the individual he replaced. Powell built his reputation around resisting political pressure and keeping rates firm. So this is the current reality. A newly installed Federal Reserve chair expected to lower rates now faces 11 committee members who disagree with him. Inflation is weakening his argument for cuts. His predecessor remains inside the institution. Meanwhile, 40 million American homeowners are waiting to learn whether mortgage payments will finally decline. Warsh has introduced a strategy that differs sharply from modern Federal Reserve policy. The proposal is called the QT for Cuts Framework. QT stands for quantitative tightening. During the COVID period, the Federal Reserve created trillions of dollars and purchased government bonds along with mortgage-backed securities in order to inject cash into the economy. The Federal Reserve balance sheet expanded to nearly $9 trillion. At this moment, it still remains above $6.7 trillion. Warsh wants that figure reduced aggressively. He supports active asset sales rather than simply waiting for securities to mature. His plan would shrink the Federal Reserve presence inside the bond market rapidly and on a large scale. In return, he argues that the committee could justify lowering short-term interest rates at the same time, reduce the balance sheet while also cutting rates. That is the compromise he is presenting to the committee. If the strategy succeeds, mortgage rates could begin moving downward. But another problem sits underneath the entire proposal. Mortgage rates do not directly track the federal funds rate. They follow the yield on the 10-year Treasury. If the Federal Reserve begins aggressively selling mortgage-backed securities, Treasury yields may actually move higher instead of lower. That means mortgage rates could rise even while the Federal Reserve cuts rates. That contradiction sits at the center of Warsh's strategy. Wall Street already reacted to it immediately. Once Warsh's nomination became official, bond markets responded with what analysts described as a bear steepening. Long-term yields climbed upward while short-term yields declined. For American homeowners, that is the opposite of the outcome they need. Now, attention is shifting toward another enormous problem inside the housing market. More than 60% of American mortgage holders currently possess rates below 5%. Most locked those loans during 2020 and 2021 when borrowing costs were near historic lows. Some secured rates at 2.6%, others at 2.9%, some at 3.2%. Those homeowners are not relocating. They are not selling properties. They are not placing homes on the market. The reason is simple. The moment they sell, they must purchase another property using current rates above 6.5%. That single factor is one of the main reasons housing inventory remains frozen throughout the United States. Even if Warsh manages modest cuts, the housing market may still remain locked. A decline from 6.5% to 6% is not enough to convince someone to surrender a 2.9% mortgage. Rates likely need to approach 5% before that psychological barrier begins to break. At this moment, no major Wall Street forecast projects 5% mortgage rates during 2026. None. The most optimistic estimate from leading economists currently points toward 2 small cuts before the end of the year. That would move the federal funds rate from 3.5% to roughly 3%. Mortgage rates might ease toward 6% or slightly lower. Those projected reductions may provide some relief, but they are far from life-changing for most American households. The political side of this crisis makes the situation even more volatile. Donald Trump has publicly declared that he wants interest rates reduced to 1%. The current range sits between 3.5% and 3.75%. Dropping from 3.5% to 1% would not be considered a normal policy adjustment. It would represent a complete break from modern monetary policy standards. Even Kevin Warsh, Trump's own selection to lead the Federal Reserve, refused to support that position during his Senate confirmation hearing. When senators questioned whether Trump pressured him regarding rates, Warsh answered directly. He stated that the president never asked him to predetermine or lock in any interest rate decision, and that he would never agree to such a demand. He delivered that statement under oath. That response established clear distance between Warsh and the White House. The pressure on that divide will intensify during the June 16th meeting. If Warsh decides to keep rates unchanged, Trump is expected to criticize him publicly. If Warsh argues for cuts and loses the committee vote, he would become the first Federal Reserve chair in history to be defeated on his own monetary policy proposal. Either result would be historic, either result would move financial markets, and either result would directly affect mortgage costs across America. But interest rates are not the only area where Warsh holds influence. His broader authority may come from how the Federal Reserve communicates with markets. Warsh has already indicated that he wants major changes to Federal Reserve messaging. He may sharply reduce forward guidance. He is also considering removing the dot plot, the chart showing where individual committee members believe rates are headed. That chart has been one of the central tools of Federal Reserve communication since 2012. Eliminating it would inject major uncertainty into financial markets. When uncertainty rises inside bond markets, yields often rise as well. Higher yields translate into higher mortgage rates. That means even communication changes from Warsh, separate from actual rate decisions, could directly change what Americans pay each month. Warsh is also the wealthiest Federal Reserve Chair in American history. His personal assets are valued far above $100 million. He previously worked at Morgan Stanley and understands Wall Street from the inside. That experience creates advantages and risks at the same time. He understands how financial markets operate. But Wall Street also understands how he thinks. And at this moment, major investors are not betting on aggressive cuts. Historical comparisons are now shaping the discussion around his leadership. In 1980, Federal Reserve Chair Paul Volcker raised interest rates to 20% in order to crush inflation. The housing market collapsed. Unemployment climbed to 10.8%. The period was painful, but inflation eventually declined. The economy later recovered. Volcker is now remembered as one of the most important Federal Reserve chairs in American history. Warsh has studied that era closely. He has repeatedly referenced sound money principles during public remarks. The central question now is whether he possesses both the political determination and the committee support necessary to make difficult decisions, or whether pressure from the White House pushes the Federal Reserve into cutting rates too early. If cuts arrive prematurely and inflation accelerates beyond 5%, the committee could be forced into emergency rate increases later. Emergency hikes during 2027 would make today's mortgage rates appear inexpensive by comparison. That possibility has become one of the biggest concerns surrounding current Federal Reserve policy. For homeowners carrying mortgage rates above 6.5%, the recommendation is to wait before refinancing and monitor the June 17th decision first. For buyers attempting to enter the housing market, obtaining pre-approval now could allow faster action if rates decline. For households with adjustable rate mortgages, the situation becomes even more urgent. Those loans reset according to current interest rates. Any additional rate hike would affect those borrowers immediately and directly. Lenders should be contacted before June 17th. The next 60 days may become the most important 60-day period for American mortgage policy in years. Kevin Warsh has now assumed control of the most powerful financial institution in the world. He inherited inflation at 3.8%, a divided committee, a geopolitical crisis, and a president demanding 1% rates. A mortgage is not just another number on paper. For most Americans, it is the largest financial obligation of their lives. The decisions made inside the Federal Reserve over the next 6 months could shape those obligations for years to come. Follow every development carefully. Stay informed on each Federal Reserve meeting. Watch how markets react. The next policy shift could change the future of borrowing, housing, and household finances across the United States. Thanks for watching. See you in the next one.